You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well this Monday. Let's be honest. There are Mondays that are easier than others, right? I want to talk about my Monday last week. A week ago, I woke up and I had my morning run, which actually was quite tough because I had a pretty busy weekend. Good food, good wine. You know the story. And then Monday morning, 5 o'clock, I had to wake up and run, and there's no excuse, right? So I did that. Everything was fine. And then checking up on my portfolio, because it's been a while. And then I look at my portfolio, and I'm like, oh my God, I am down $28,563, like almost 30 grand down since the beginning of the year. So on January 1st, my pension plan portfolio, because I'm looking always at that pension plan because I'm not adding capital to this one. It's a Lira account, which is great because it's locked in. I use it as a case study on the Dividend Guy blog. I report my portfolio every month, my position, the dividend I make, the moves I make, everything is there at the Dividend Guy blog, just to show you what's the real life of building a portfolio, managing it, and not adding capital to kind of like give you the impression that the portfolio is growing or not getting hurt too much by the market by adding more capital. Well, this one can't do anything of that. So on January 1st, the portfolio was almost at $302,000. So it was $301,964. And on April 14th, before the market opened, fortunately it was a good day. So at the end of the day, it was better. But still, before the market opened on April 14th last week, the portfolio was $273,400, so down 28.5K, or if you prefer, 9.46 or 9.5% down. That's not good. I mean, it's pretty bad. If I look at my benchmark, it's 100% invested. And it's in Canadian and US market. So if you look at XIU tracking the TSX, so the Canadian market, the XIU since the beginning of the year was down 3.58%. And I can look at VFV. So VFV is a Canadian version of an ETF tracking the S&P 500. So not edge for the currency. So it's really giving you a better benchmark in this case because I'm investing in US stocks, so I benefit or I suffer depending if the US dollar gets stronger or weaker. So the VFV was down 11.78%. If I do a prorated average of that, because my portfolio is like 58% US, 42% Canadian right now, I get to the magical number 8.33%. So a long story to tell you that on April 14th, I was not only down $28,000, but I was also underperforming the market by roughly 1%. So not that great, right? Not good news on any stage. So today I wanted to show you how I deal with this, how I deal whenever I have a bad day on the market, a bad segment, so that was a little bit more than a quarter, what's happening. And I usually have like kind of like three steps I want to share with you so you can do the same thing with your portfolio and maybe hopefully feel a little bit better or at least increase your conviction in your strategy and in your portfolio. So number one, it's all about perspective, right? Short-term versus long-term. It's a classic, but I have to talk about it because it's so obvious. Short-term result, I'm down 9.5% since the beginning of the year. Long-term result, I am up at an analyzed growth rate of more than 13% since September 2017, the moment I receive my pension plan, the value of my pension plan. So the portfolio is up more than 150% for an analyzed growth rate of 13. 13 is like twice what I project in my financial projections for my retirement plan. So I use 6.5 while for the past almost 8 years now, I averaged 13. That's crazy, right? So I can probably stomach a 10% drop without whining because I'm still up 150% and more even after that drop of 10%. That's kind of crazy. And I didn't add any dollar. I just want to make it clear. So that portfolio started with 108. Now it's at 273. Yes, it was up to 302. That was amazing. Crushing the $300,000 milestone with the portfolio, but still in perspective, does it really matter if I'm at 300 or 273 when I started with 108? I mean, that was like great returns. So in perspective, not that bad. The second thing is to focus actually on the process and not the results. It's easier to say than doing it. I get that. But I mean, several years ago, I read Atomic Habits, and Atomic Habits changed my mind about that. I mean, in one place, James Clear, the author, says, you can, like, if you're a basketball coach during a championship, you can watch the scoreboard the entire game because the scoreboard is going to tell you if you win or if you lose. So that's the results. You can watch it the entire game. It's not going to change anything to your game. You're not going to have any impact on the results. So what you can do though is you can train your team, have like good strategies, and focus on that process that could eventually lead to winning a championship, but that you don't know what's going to happen. So and that I apply that to everything to my life. Actually, with my, I coach kids at futsal, that is interior soccer. This is exactly what I told them at the beginning of the season. We didn't have a good start, actually. We were almost last for the entire season, but at the end, we focused on the process the entire time, and at the end we racked up like several wins in a row, ended up going to the regional championship. We didn't win, of course, but I mean, it was a great experience to focus on the process and then get the results. So instead of looking at my portfolio, the result that I'm down 10% right now and losing a lot of money on stocks, I'm just thinking, am I like losing a lot of money on specific bad investment, or is it just the market being crazy? And the market is being crazy. I mean, if I had invested in index funds, I would be down by 8% instead of like down by 9.5. Not a big difference. I mean, 8.33, 9.46, not going to change much in terms of difference. So definitely that's the problem is the market, not my process. Did my process work in the past? I mean, I just told you about analyzed growth rate for the past 8 years. I've been a dividend growth investor for the past 15 years, and I've been all in invested in stocks always, all the time since 2003. It's been like 22 years now and counting that I'm using like a similar approach, and it's working. So and am I following my process right now that I've been following since I started dividend growth investing in 2010? Yes. So is there a problem here? Not at all, because I focus on the process and my process is doing well. I still have the same type of businesses I want in my portfolio. I don't care about the short-term results. So that's number 2. Number 3, that is super important, is the dividends are telling me a different story. There's a big difference between what's happening within a business and what's happening with its stock price. Imagine that you would have been an investor in Dividend Stocks Rock, my membership website. Imagine if DSR was a public company in 2020. The entire market was down 35% in March, right? Well, you know what? In March and April and in May, my sales were growing double digit every single month versus the last year. You know why? Because I kept on doing webinars. I kept on informing people. I kept on helping investors literally invest with more conviction, because that was a really hard time. So the reality of my business was the business was doing great. If DSR was a stock back then, it would have fell by like 30 or 40% easily at the beginning of 2020. Another great example that you can relate, Microsoft in 2022. If you remember correctly, we had higher interest rates that plummeted the tech world. The NASDAQ was down more than 20%. A lot of the big guys, such as Microsoft, I think Microsoft was down either 25% or 30% this year. Crazy bad result for the stocks. If you looked at the numbers like that year, revenue and earnings and dividend were all growing high single to double digit, every single of them. So the business was thriving, kept on like, you know what? Revenue keeps on increasing. We make more money. Profits are high. We increase our dividend. And yeah, well, the stock price goes down. So how do I get that conviction when my stocks are going down? Instead of looking at the stock price, I look at the dividend over the past 12 months. You know what? Just for fun, I just did it quickly. And all of my companies have increased their dividend, but I have a long list of double digit, more than 10% dividend increase in the past 12 months. We have Alimentation Couche-Tard. We have CCL Industries, Stella-Jones, Automatic Data Processing, Brookfield, Lemaitre Vascular, Visa, Waste Connection, Microsoft. All of them increased their dividend by 10% or more. More than 5, we have National Bank, Royal Bank, Starbucks, Toromont Industries. I mean, that's the bulk of my portfolio. Like the wide majority of my portfolio has increased their dividend by at least 5% or more. So the company is telling me, we are doing just fine, Mike. Just go back to your morning run and you don't have to worry about anything. Maybe you should slow down on the good food and the wines and the friends, but you don't have to worry about your portfolio. It's all good. So to wrap this up, I do 3 things. I put my portfolio returns in perspective, so short-term versus long-term. After that, I look at the process, making sure I follow my investment strategy. I follow my process. That's super important. As long as I focus on the process, I will get long-term results. That's good. That's valid for anything you do in life. Finally, the dividends will tell me a different story. If the dividend increase on a bad year, that tells me the business doing fine and they have the means to grow the business and also reward shareholders. So it doesn't matter if the stock price goes down because it's just a temporary storm. So I hope that you have enjoyed this podcast. And if you're more curious about how I build my portfolio and I run my investment, you can go to moosemarkets.com/income. And then you're going to be able to download the Dividend Income for Life guide that explains my entire investing strategy and my process. So moosemarkets.com/income. We're going to see you there. And until tomorrow, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.